Most founders that we start working with think they know how much runway they've got, which is perfectly great. And a lot of the times they do, but sometimes we work with founders who don't. And usually these founders, they look at the cash in the bank, maybe the burn rate, quick bit of maths on the top of that, and job done. And in our work with startups across lots of industries, we've seen this same mistake and again and again. And unfortunately, the cash runway calculation can be wildly off. So today I wanted to break down 8 common issues that we see with cash runway forecasting in startups and what you can do instead. My name is Alysha Randall. I am a fractional CFO and I also founded Fast Growth Consulting, where we help founders not only understand their numbers and get something more than just this is what we did last month from their bookkeepers and tax accountants, but rather using the finances so you can be more strategic, much more commercial, and make sure you're making the right decisions. We also help founders with their fundraise. The numbers have to be pretty accurate and you have to have a pretty good investor model when going to market, and that's where we help. So, 8 things or 8 common issues that we see with cash runway calculations or understanding. The first one is confusing run rate with reality. So, often, as I said, the common thing I see is looking at the burn rate, which is how much you spend in the most recent month. Have a look at how much cash is in the bank and then divide one into the other. So let's say, for example, you spent about £100,000 last month because you're at the very early stage, you're not quite at a profitability yet, and so your burn is £100,000 last month, and you have £1 million in the bank. So you think that 1 million divided by 100,000 is 10, and that is your cash runway. But actually, if you have a look closer, that monthly spend isn't actually what's going to happen in the future. This kind of calculation of monthly spend or your burn rate works really well with large corporations, but it doesn't work with fast growth businesses. So we have worked with a B2B SaaS founder where they actually thought they had 9 months runway. And when we looked a bit closer, we probably spent about a few weeks on it. We had looked that hiring had ramped up, ad spend had changed a bit. There was a few chunky annual renewals that had hit account. There was a couple of annual spends that hadn't hit the account yet, but we knew were coming. And unfortunately, this all masked the actual runway and it was lower than 9 months. So to track your actual cash out monthly, ideally you want to have a cash forecast. So a 12-month rolling forecast that includes spikes and spends, seasonality, one-off costs. This is a really good way to start and it helps you calculate your cash runway much more accurately. We do have a resource available, a free resource if you want to have a look. It's called a cash flow template. I go through this in detail in a video. So we'll leave the link below to that cash flow template, but also you can see a link above to that video as well. Number 2 is assuming that revenue will land on time. Now, if you get all of your revenue digitally, and you have a subscription model, great. This is probably less of a problem for you, so you can probably skip ahead for 30 seconds. But if you're sending out invoices, you need to understand that when you invoice and the revenue is recognized in your P&L, that might not necessarily be when your cash actually hits your bank account. So I would actually say on subscriptions, there can also be a challenge there as well, because if your subscribers pay on an annual basis, you'll have the same problem. You will have a monthly revenue coming through your P&L every single month, but that is quite different to when the cash hits your bank account. So when you're looking at your cash forecast and to predict when the runway runs out, you need to look at the cash, when the cash is going to hit your bank account, rather than when the sales team celebrate because they've just landed a sale. So forecast revenue on a cash basis. If you invoice on the 1st, When does it actually get paid? Are there refunds? Are there churn risks? Is there onboarding delays? All those things need to be considered when you're looking at the income or amounts coming into your bank account. Number three is underestimating seasonality or lumpy revenue. So if you're a monthly subscription only model, then yes, but revenue rarely arrives smoothly monthly. So if you've got seasonality demands or lumpy B2B contracts, even with subscribers, then runway calculations, if you assume that your revenue's flat, that's going to really mislead you. So we actually saw a B2C startup that did 40% of their annual revenue in Q4, which is very common in a B2C kind of retail type business. And they were modeling Runway with even monthly revenue across the year. Unfortunately, that meant that they almost missed payroll during summer. So we had to very quickly make some strategic decisions so that they wouldn't and could carry on no problems. So really review historical patterns and just make sure that your revenue incoming reflects reality with your cash forecasting. Number four is forgetting irregular or deferred costs. So this one's quite subtle. This is the opposite of revenue. So costs are known, but they're not always paid monthly. Perfect example is audit fees, if you have them. If you're an early stage founder, you probably don't have to worry about this. VAT payments, so tax payments, they're usually quite lumpy. You don't usually pay tax every single month. That's usually quarterly or annually. Insurance is another one. Insurance policies are probably paid annually. Inventory, that's lumpy payments as well. A lot of professional fees like legal fees, they can be quite lumpy. Or rent, there's another one. If you're a rental, that's often quarterly. So if you're looking at your burn rate instead of a cash flow forecast and you're looking at a particular month that doesn't have these lumpy costs, then you can really get a real shock actually when you realize that your burn rate can fluctuate quite a bit because of these kind of things. So we really do need to understand when the costs actually come in. And again, sometimes that's looking at the history or using an accountant or a fractional CFO like us to help you make those decisions. Number five is forgetting the fundraising buffer. So not only does fundraising take a really long time, it used to be, I'd say, 3 to 6 months a few years ago. We're now looking at 6 to 9 months, even longer. So you need to make sure that when you're starting your fundraising process, that you have enough runway in order to allow for delays. So ideally, you want to be going to market at 9 to 12 months runway or 12 months plus if you want to have that extra, if you're a bit concerned about how much you're going to raise or how quickly. The more buffer you have, the better. If you're going to market with only 6 months runway, you're probably going to have to accept terms that aren't ideal, or you're going to have to go to your existing investors and ask for an extension round or a convertible loan note. So the earlier you go to market with the longer runway, the better. I will say also, if you get a term sheet from a lead investor and it's looking like you are getting close to ending the round, it can still take another 3+ months because you have to go through due diligence, you have to go through all the legals, and then even when all of that's done and you close the round, it can still take, I've seen up to another 8 weeks before the cash is actually deposited into your bank account. So you really need to allow for that buffer so that you don't start panicking and accepting unfavorable terms. Number six is no plan B when targets are missed. So if you have somebody helping with your forecasting or you're forecasting yourself, I would say that you really do need to make sure that you have different scenarios. So it's very common for businesses to have, say, a base case or even just a stretch case scenario, but it is good to have a worst case scenario as well. So if you don't hit your revenue, something out of your control happen, COVID anyone, what if the costs creep up? Or the cost of living crisis? What happens if hires take a lot longer? What if churn is a bit high unexpectedly? It's worthwhile having a downside plan. I would say roughly 20% revenue less than what you have forecasted. If there's no plan and no reforecasting and panic hiring, freezing kicks in too late, then you could be in trouble. The reason why it's good to do this type of scenario to help with largely cash flow runway is because you want to understand how much you want to retain that runway for as long as possible. And if you don't have a contingency plan, then trying to make the decision of how to extend the runway is much harder when you're in it. And when the runway is really short, then having a bit of time to make payment plans or not hire someone instead of making redundancies, those type of things. So if you don't know how to do this, then do reach out to me, as we help founders do this all the time. Number 7 is forecasting based on optimism and not data. So when you're doing your cash flow forecasting and you want to rely on that, you want to rely on the revenue that you are potentially budgeting for as well. And the best way to do that is to use data to help you make those predictions. So if, say, for example, you have a 10% uplift in your revenue, then you want to know what that 10% uplift is the result of. It's not going to magically increase because you put it in a budget and you've told your team to work harder. There needs to be a reason as to why it grows. So a fintech client we worked with once, they assumed that they would get 10% month on growth based on gut feel, really. And actually, their month-to-month growth was actually only 3%. So they had a 7% shortfall, and this forecast overestimated cash by £200,000 over 6 months. This is a big gap and a big problem. So use data, track your lead to sale conversion, your average order value, your CAC, your churn, all those kind of metrics that can help feed into your forecasting. So a fractional CFO, of course, can help translate this into a usable model. You don't have to do it yourself, but worthwhile saying that if you're assuming that you're going to get more revenue into your cash forecast because of gut feel, you may want to revisit that. And then finally, thinking Runway is just a finance problem. Runway isn't just about cash, it's about communication, it's about decision making across the entire business. If your marketing lead doesn't know that there's a 6-month horizon, they may overcommit and spend. If your product team is unaware, hiring plans may not be sustainable. So a startup we work with discovered that their runway was only 12 months, but the leadership team was still approving spend like they had 36 months. So the founder hadn't shared the real cash value picture. So we really did unfortunately have to come in and set the scene. With the leadership team, particularly mature leadership teams working in startups should know that cash is always a factor. Make sure a runway leadership discussion happens just so that people are aware, so they'll make decisions slightly differently. But it's also, you don't want to be telling the entire employees that you're going to be running out of cash because you can have a retention problem. But rather, it's having an adult conversation with the leadership team to say, we have this much cash runway. This is our plan to extend it. This is what we need to do. You want to bring the senior hires into the budgeting process and treat Runway like any other strategic KPIs. So if you want a finance function that's built for growth or for a future fundraise and not just compliance, this is how we help. So subscribe to this YouTube channel. We talk about finance for startups. This is our bread and butter. We work with startups and founders every day. We look at startup finance, fundraising prep, hiring support. So I talk about all these things on this channel. We also have lots of free tools like the fundraising checklist. How prepared are you for a fundraise, or a hiring calculator to show you how much a new hire actually costs the business. So have a look at our resources page. The link will be below and you can have a look at that. We also have a 3-month program called the Financial Foundations for Founders, where we get startups investor ready for a future fundraise. And you might want to take a look at that. So if that looks interesting to you, then again, please click on the buttons below. Aside from that, that's everything from today. Hopefully you found that video useful, and I look forward to seeing you in the next video. Cheers.